Every business leader dreams of growth, right? Big sales, big profits. But what if I told you there's a hidden speed limit to how fast your company can expand? A point where hitting the gas actually starts to do more harm than good. Well, today we're going to pop the hood and figure out exactly how fast your company can sustainably grow.
All right, here's our game plan. We'll kick things off with something called the growth paradox. Then we'll uncover the real price of expansion. After that, we are going to build the sustainable growth engine piece by piece. Then we'll figure out how to calculate your company's actual speed limit. And finally, we'll see what happens when you try to redline it.
Okay, so let's dive right into our first big idea, the growth paradox. It's this super counterintuitive concept that just selling more stuff isn't always the magic bullet you think it is, and understanding why is absolutely critical.
I mean, check this out. This is the kind of chart that makes investors' eyes light up. Sales are skyrocketing and profits are going up even faster. It's that beautiful hockey stick curve every single company dreams about. This one's planning to quintuple its revenue in only 6 years. I mean, that's amazing, right?
But here's the thing. What's really hiding behind this perfect-looking chart? What's the real story behind the numbers? What does it actually cost a business to pull off this kind of massive expansion? That beautiful curve? Well, it doesn't tell us the whole story.
And that brings us to the real price of growth, because growing isn't free, not by a long shot. It eats up resources. I want you to think of your company like a high-performance car. The faster you want to go, the more fuel you're going to have to burn.
First off, you just need more fuel for the day-to-day grind. As your sales climb, you need more cash on hand for everything: payroll, materials, you name it. Plus, more of your money gets tied up in inventory, sitting on shelves, and in invoices that your customers haven't paid yet. That's all your net operating funds, and believe me, it has to grow right along with your sales.
And it's not just about the cash you need for daily operations. No. To make more stuff, you usually have to invest more. We're talking about buying new machines, upgrading your tech, maybe even building a bigger factory. These are your fixed assets, and they're the backbone of your ability to produce more.
So here it is, the absolute bottom line, the fundamental rule of business. None of this stuff just appears out of thin air. All those new assets, the operating funds, the fixed assets, they have to be paid for. For every single dollar of new assets on one side of the books, you need a new dollar of financing on the other. Period. Okay, so if growth is so darn expensive, how can any company fund it without constantly begging for outside cash? Well, the answer is to build a self-powering financial engine. Let's take a look at how this creates a really powerful, sustainable cycle. This engine works in 5 pretty simple steps. You start with a solid, balanced financial setup. Then you go out and make a profit. Here's the key. You keep some of that profit in-house instead of paying it all out to shareholders. You then use that cash you kept to invest in new assets, which, you guessed it, lets you make even more sales and generate even more profit. And boom, the cycle starts all over again.
All right, let's put some numbers to this to make it real. Picture a company on day one. It's got $1,000 in assets, and that's funded by a really healthy, balanced mix. $500 in debt and $500 from the owner's capital. This perfect 50-50 split, that's our ideal structure.
Okay, fast forward 1 year. The business does great, makes $100 in profit. And now they face a really important choice. They decide to pay out half, $50, to the shareholders as a thank you. But they keep the other $50 right inside the business. And that $50, that's the first shot of high-octane fuel for our engine.
And this is where the magic happens. This is how the engine really starts to purr. That $50 in retained profit beefs up the company's capital. And because the company is committed to keeping that balanced 50-50 debt-to-capital ratio, it can now go out and borrow another $50 in new debt. Add it all up, and that's $100 in fresh financing, ready to buy new assets and power the growth for next year. So, we've built the engine. We see how it works, how it creates this awesome cycle of growth funded by its own success. But, every engine has a red line, right? A top speed. So let's look at the dashboard and find the one number that tells us exactly what that speed limit is. And that red line has a name. It's called the sustainable growth rate, or just G for short. Think of it as the absolute maximum speed your sales can grow without you having to do one of two things. Either take on way more debt than you should, or go back to your shareholders with your hat in your hand asking for more money. It's the growth you can fund all by yourself. And you know what's cool? Figuring it out is surprisingly simple, but the formula is incredibly powerful.
It's your return on equity, which is just a fancy way of saying how good you are at making profits with your shareholders' money, times your profit retention rate, which is just the percentage of profits you plow back into the business.
So let's plug in the numbers from our little company. It made $100 a profit on $500 at capital, so that's a return on equity of 20%. We know it keeps half or 50% of its profits. So you multiply that 20% ROE by the 50% retention rate, and there's our answer, a sustainable growth rate of 10%. That's it. That's this company's official speed limit.
Now this is the master blueprint. What I love about this is it shows you that your growth rate isn't some random number that just happens to you. It's the direct result of the choices you make, how efficiently you run your operations, how you decide to finance the company, and what you choose to do with the profits you make.
And we can break it down into 4 main levers that you can actually pull. First, your profit margin, how much you pocket on every sale. Second, your asset turnover, how good you are at using your stuff to make sales. Third, financial leverage, that's your debt policy. And finally, profit retention, your dividend policy. Every single one is a lever you can adjust to change your company's speed limit.
Okay, we've found our speed limit, we know the safe zone, but what happens when ambition takes over? When a company decides to just floor it and try to grow way faster than what's actually sustainable? Well, this is where things can get really dangerous. And the difference between these two paths is, well, it's night and day. Sustainable growth keeps your finances healthy. It's funded by the profits you earn. It leads to stable, controlled expansion. But when you force growth, you have to pump it full of excessive debt, and that just wrecks your financial structure, creates a ton of instability, and puts the whole company at risk. And don't just take my word for it. The source material lays it out perfectly clear. Forcing growth beyond this limit almost always means piling on way too much debt, which can quickly spiral into serious financial trouble. It's the classic story of short-term ambition creating huge long-term risk. So all of this, it all boils down to one essential question. It's not about how fast you want to grow. It's about truly understanding the financial engine that powers your business. So when you look at those levers you can actually pull, your margins, your efficiency, your debt, your dividend policy, what is your company's true speed limit?